Hello, my name is Stephen Geist, and I'm known in the Denver area as the retirement guy. And that's because, as a financial strategist, I help people achieve financial well-being in retirement. So in part one of this two-part learning video, I'm going to talk about retirement puzzle piece number one, which deals with how to diversify and protect your assets in retirement. Since the 1980s, the rise of the power brokers on Wall Street has led to a series of increasingly severe financial crises. Each crisis has caused more damage to our economy than the previous, while the financial industry has made more and more money. The financial crisis of 2008 and the Great Recession that ensued was not an accident. It was caused by an out-of-control financial industry, and many key players are still at it, both on Wall Street and within the federal government. The stock market can rise and fall in a volatile fashion. And to drive home this point, let me remind you of the stock market collapse back in 2008. On September 29th of 2008, the Dow Jones Industrial Average had its biggest point loss in history, dropping 778 points in one day. On October 9th of that year, the Dow Jones Industrial Average dropped another 679 points. On October 22nd, the Dow dropped another 514 points. On December 1st of that year, the Dow dropped another 679 points. In all, from the top of the stock market in October of 2007 to the bottom in March of 2009, just 1.5 years, the stock market lost over 50% of its value for the second time in just 8 years. Wall Street will tell us that we need them. Wall Street will tell us that what they do is too complicated for us to understand. But not to worry, Wall Street says. What they do is in our best interest. Wall Street will tell us that another financial collapse will not happen, yet Wall Street will spend billions of dollars fighting reform and regulation. As a result of the Great Recession from 2007 to 2009, we're now living in a whole new normal. That means preparing for a different kind of investment environment. 2 recessions in just the last 15 years have resulted in 2 dramatic stock market downturns. For many people, broad diversification of risk-based investments, that was not enough to prevent huge losses in their retirement portfolios. Yet the conventional wisdom on Wall Street still maintains that smart retirement investing is all about building a portfolio of stock and bond-based investments that will hopefully provide an adequate total return over time. Wall Street's conventional wisdom says that stocks are safe in the long term, and that owning significant portions of stocks is necessary in order to produce a secure retirement. Many advisors on Wall Street continue to operate by the bull market playbook, which is take on risk, stay fully invested, buy the dips, stocks and bonds always outperform. But the reality is that giving this kind of Wall Street advice to a person in or near retirement, that can be disastrous. Consider for a moment the risk to an individual in or near retirement when an advisor puts together a financial strategy heavily weighted towards stocks, bonds, mutual funds, and commodities. That advisor's financial model will typically either ask for or rely upon assumptions for many events that are wildly unpredictable, such as how long you will live or how your health will be, or those assumptions will be grossly overstated in terms of expected rates of return on your risk-based investments. Think of the uncertainties in your retirement. You don't know how long you'll live. You don't know how your health will be. You have only a limited amount of savings. You don't know what gains or losses you'll have on risk-based investments, and there are no second chances. Wall Street's stock and bond portfolio can fluctuate dramatically in value, subject to the volatility of the market. And since we don't know how long you'll live, you should be very reluctant to spend down any of your principal inside your risk-based investment portfolio. In this age of new normal, the more you know about asset diversification, especially which assets provide guarantees and which assets carry various degrees of risk and reward, the better off you're going to be. Plus, you won't be so inclined to listen to the Wall Street propaganda machine. The more you know, the less likely you'll be to panic and make a bad decision in the next market downturn. So to put today in perspective, let's go back over 80 years to the great market crash of 1929, a time when fortunes were lost. By July of 1932, the stock market had lost 87% of its value. And we didn't see anything like that again until the year 2007, which has now become known as the Great Recession. So let's look at this bar graph for a moment that depicts all the bear markets we've had since the great market crash of 1929. There have been 14 bear markets since then. And a bear market is a prolonged period in which investment prices fall. It's accompanied by widespread pessimism. Bear markets usually occur when the economy is in a recession and unemployment is high, or when inflation is rising quickly. And in looking at this graph, we can see the severity of the bear markets over the last 80 years. And notice that the average decline for a bear market is 38%. The average duration of a bear market is 1.5 years. And the average time to recover, or to get even from the losses of the bear market, it takes over 5 years to accomplish that. So the volatile roller coaster ride of the last 18 years has been pretty severe. The buy and hold concept of Wall Street, or maybe we should call it the buy and hope, that concept, that strategy has not always worked out that well. Let's look at this graph going back to 1997, a graph that has watched the S&P 500 index over the last 18 years. In the last few years of the 1990s, we noticed that the S&P 500 index was up 106%. Then in March of the year 2000 was the first downturn, the first recession of the new millennium. The stock market, as measured by the S&P, lost 49% of its value. It then took 5 years in a bull market to recover those losses, a bull market that grew 101% and basically got us back to even. Then we started the Great Recession beginning in 2007. And during that 1.5 years of the Great Recession, the stock market, as measured by the S&P, lost 57% of its value. And now we've been in a 6-year bull market. This graph showing that as of March of last year, the S&P 500 had grown 177%. But there are many things that Wall Street doesn't talk much about, and I'd like to cover a few of those items. Issue number one are long-term secular cycles. The stock market operates in long-term secular cycles. A full secular cycle can last 25 years or more. So in a secular bull market cycle, the prevailing trend is bullish or upward moving. In a secular bear market cycle, the prevailing trend is bearish or downwards or sideways moving. And within every long-term secular cycle, there are shorter cycles of recession and recovery, little bulls and little bears, each cycle lasting on average 5 to 8 years. So despite Wall Street's recent hoopla about the surging stock market, which we've recently exceeded, we've only recently exceeded the pre-recession market highs way back in October of 2007, or even in March of 2000, which was 15 years ago. More than one economist has made the case that our current economy has been in a secular bear market cycle since the year 2000, 15 years ago. So if that's the case, how long might this secular bear cycle last? Might there be another bear downturn in this cycle? Well, based on historical research, some economists predict that our current secular bear cycle is only about 2/3 of the way done, and quite possibly could have one more bear market within it. Another issue with Wall Street is that markets move on emotions. When the stock market is functioning properly within secular cycles, stocks and bonds in your investment portfolio should either increase or decrease in value based on the underlying fundamentals of those assets. But all too often the stock market oscillates, sometimes dramatically, based on emotions and reactions to news stories from around the world. Another issue with Wall Street is the impact on the stock market from high-frequency trading. You know, there are some very smart humans who have designed some very sophisticated computer algorithms that place blizzards of buy and sell orders, many of which are instantly canceled, all in an effort to detect and exploit the tiniest shifts in demand for stocks. And this kind of trading now generates some 2/3 of all share volume on U.S. markets. This flood of orders, driven by not by investors evaluating stocks, but simply by computers, that makes markets increasingly vulnerable to incidents like the infamous May 2010 flash crash. The stock market at that time plunged hundreds of points for no evident reason and lost 10% of its value in just a few short minutes before it ultimately recovered. Another issue with Wall Street is the idea of investing versus speculating. So what's the difference between investing and speculation? Well, the meaningful and the traditional idea of investing is that you buy something and you get paid for owning it. If you buy an apartment building, you're collecting rent. If you buy a bond, you're collecting interest. Speculating is something entirely different, yet it is commonly mislabeled by Wall Street as investing. Your stockbroker realizes that speculating has a negative ring to it, so the best way for him to get you to speculate is by convincing you that you're investing. But if you buy an asset simply because you hope that you will be able to sell it for more at some later date, you are speculating. And the stock and the real estate bubbles of the last 14, 15 years have been rife with speculation disguised as investments. So for this learning video, an opportunity to take action, one would be sure to tune in to part 2 of this 2-part learning video regarding this puzzle piece number 1. And then there are my special reports, one of which is called 18 Mistakes by People in or Near Retirement. You may want to order that. Another report, Don't Be Duped by the Wall Street Propaganda Machine. But the most important thing you can do right now is to click on the Take Action Now button to the right. This Take Action Now button will allow you to sign up for a free 1-hour consultation with me in my office. So that's it for this puzzle piece. Thank you for tuning in. Be sure to listen to Learning Video Part 2.